I want to wish everybody a very happy holiday season and welcome to the Strategy Asset Managers 2026 Year Ahead Investment Outlook. My name is Tom Hulick, and I'm the CEO of Strategy Asset Managers. Joe Traba, my Chief Investment Officer, and Alex Hagstrom, my Senior Portfolio Manager, and I will go through what our plan is for 2026 and kind of reflect back on what worked and where we see things in the next couple of weeks for the year end. I would like to say that I'm very grateful for being able to successfully conduct these calls. It's been over 12 years now since we started the firm. We are cracking the $1 billion mark in assets under management. Thank you to you all who have supported us. And I would like to say, Joe, great job, and Alex, great job on the continuation of the success that Bob DeMichael, graciously allowed me to be the steward of years ago for Strategy Asset Managers, because the investment returns continue to exceed expectations, and we remain in a very strong position as a leader in each of the different categories for investment management. We did have a great year. And as you know, we heard from Federal Reserve Chair Jerome Powell. They lowered interest rates 25 basis points. We will talk a little bit more about what the expectation is in January and furthermore into 2026. A few announcements to make because we are one big Strategy Asset Managers family. I would like to say happy birthday to David Bass, a longtime friend. And this is also a very busy month for birthdays in my world. All four of my blended family daughters will have birthdays this month. My daughter Holly will age up on December 25th. And then we have Juliet, Catherine, and Sarah on the 17th and 18th of the month. And one will actually be graduating from Cal Berkeley next weekend, December 20th. And that is going to be quite an accomplishment because just like many of the recent college graduates, she'll be looking for a job in one of the toughest job markets that we've seen in my lifetime. We will touch on that. You should also know, this is a very important announcement, that my Tulane Green Wave made the college football playoffs. And on Saturday, we go up, or 2 weeks from, or a week from Saturday, we go up against Ole Miss at 12:30 p.m. Pacific time. And if the world shines on Tulane and we win, Tulane would then take on the University of Georgia in the quarterfinals. We know that's going to happen. So that is going to be my prediction. So now we can go into the good stuff and talk about what's happening with the outlook. We did have a challenging market in 2025. Joe will talk about the 20% correction that we had in the spring, geopolitical tensions, and the 43-day government shutdown. Consumer sentiment is very low, but the U.S. equity markets finished the year on firmer ground. And as the Fed signaled the 25 basis point cut today, optimism is building for a smoother and more growth-oriented 2026. I'm excited about what the outlook is. We've been positive about the equity markets in the sectors that we've participated in. And it's important to know what to own, and also important to know what not to own. I'm going to turn it over to Joe Traba. Welcome again to our market outlook call. Joe, take it away.
Thank you, Tom. And unlike Tom's football predictions, our stock market predictions will be a little different and maybe not such a outlier out there. But as we finish 2025 and look at 26, the optimism that we have continues. And what we want to get people more in the habit of is not to get sensationalized by the negative news out there. And one of the big themes out there that gets me a little bit more optimistic is, like Tom mentioned, the low investor optimism. And we'll get into that a bit. But the two big things that we've looked at are the AI push, which really is the infrastructure build out, and that is going global. And it's also the application of AI. Those are two things to look at and to think of positive instances of how this can, not just affect our portfolios, but also your life. The next one is getting a little bit more into what have happened with policy interest rates. What does that mean to you? So we'll talk all of that and leaving it with obviously jobs and what's the positive sentiment from that on the geopolitical side. So to start us off with AI and infrastructure, um, yes, you look at the market and what has been it dominated by? It's been a few tech companies that have really done a lot of heavy lifting. But this year, it's the first year, only two stocks of you really think of the big Mag 7 are outperforming the S&P 500. And yes, they attribute to almost 45% of the index's return, but what we've seen is a breadth improving. That means more stocks are participating. It's also the first time we've seen global, these are international markets performing well. So that is a lot of positive sentiment that I think people are, not paying attention to. And that's very good for us. So as this market continues and as we get into next year, I think that'll continue. Um, Now, when we get into AI, a lot's been made with the specific instances of it, but we look at the infrastructure. And what do I mean by that? It's in order to have technology and how much energy is required for this, that is a giant boom. And you look at the major developed countries that are able to manufacture at low levels, it's because they have cheap energy. And we think that is going to be a big push that we started to see this year, and it's going to continue. And we can look overseas as well as a big push. Now, Alex has some good comments to make about just where we stand as a competitive nation.
Yeah, and America has a very strong competitive advantage in AI, not just because this is where the technology was developed, but also thanks to our natural gas resources. So the US is the largest producer of nat gas in the world. AI is incredibly hungry for electricity. There's going to be significant expansion required to the power grid. This is, primarily going to include natural gas and nuclear, but ultimately lower electricity costs relative to other countries are going to help allow the United States to maintain its lead in AI over essentially any competitor other than China. We have the lowest electricity costs here.
Yeah, and the next phase is to start thinking about the applications. And Tom and I were talking about this, and you really have to think, how are you using it? Now, most people might have gone to ChatGPT to reword a letter they're writing or an email, but you have to really look at all the other applications from it. And what I think was really interesting, and I just use technology as a general term, but if anyone's been to a hospital and if there's ever a better company or industry that needs to be revamped, it's our healthcare system. And that gets me a lot more positive on some of the things that we can see. And what I mean by that is if you look at what they're doing, they're demoing right now in some of the hospitals, not in the US yet, but triage, when you go to ER, we've already seen this that it can be done without going to a hospital if you have the correct equipment. So I think that's going to be a really interesting application that will be very positive for not just us in the US, but it does have many other good applications. Alex ran across a really good note with some information about New York City. Alex?
Yeah, so there's approximately 1 million people in New York City alone whose job, whether paid or unpaid, is essentially nursing for their family. And robotic technology, AI technology, is going to allow for a lot of those roles to be replaced or enhanced. And I think we're looking at a future where these extremely large costs of caring for family members go down to, really near zero. You're just going to have to buy a robot, and that robot is going to handle all of the nursing needs for your family as they age.
And again, these things you just have to start thinking of the what ifs, the possibilities, and I think that's what gets us, motivated and just thinking of the what if. What can this do to help you? Now, we're going to take a step backwards. And what we mentioned earlier was talking about sentiment being really unequal. And you might have heard about a K-shaped recovery, but what does that mean? It means the environment is good for people that own assets, and it's not good for people that are borrowers. In simple terms, that means people that had assets, meaning they have a 401k, they own a home, they've done very well because these assets have continued to go up. But if you don't own these assets, your bills have gone higher, and that is a bigger percentage of your take home. So you see this struggle that's going on, and that is real, and that is measured by the sentiment that we've seen out there when you do these pollings. But it's also when you look at ADP, that's just a big company that does tracking of employment. And what they've seen is small firms continue to be firing workers. It's the large firms that are continuing to hire. So that's another dislocation. And when we look at companies, a Macy's or a high-end retail or any of the retail that have middle and high income earners, they continue to do pretty decent results. But when we look at the lower end companies like a Procter and Gamble, their sales were sluggish, and they're still expecting significantly lower sales. So that's what we are seeing with this bifurcation. What's important to remember for the stock market, who owns stocks? And it's the people that own assets. So, kind of think of it that way, and maybe that helps you explain a little bit why the sentiment can be so low, but the market's doing well. What's an also interesting standpoint, when you see sentiment at these levels, this is already typical of being in a crisis where the market's, drawn down already. So what does that mean? Well, it means for next year, what if we get positive surprises to the upside? That can lift sentiment, and obviously that would be good for not just the markets, but for a number of other sectors to not have that angst in us. And that gets us to when we look at next year and again, the end of this year, what are some of the tailwinds that we think are supporting the market? And if you've heard our calls before, we talk about earnings, and earnings are still growing. That's a positive. And they're expected to grow roughly around 11% this year. And then next year, an increase of close to 13%. And then even the following year of 27, higher. So earnings are still moving higher. And again, what's interesting to see is that financials, they don't have to lead the market, but they need to participate. They did that this year, and they did that globally in a big way. So that gives us some more, confidence that this market has some more room to run. Now we look at the environment and the backdrop on why we think this is supportive. Well, let's start off with interest rates. We'll go into that in a little bit, but I also want to think of interest rates, policy, and what are some of the efficiencies that are happening. So all of those together give us a pretty positive backdrop. Alex, did you want to talk a little bit about where the now interest rates being announced today, what we kind of think of the new norm?
Yeah, very timely given the interest rate cuts today. And we're in a new regime because while this is never going to be formalized or admitted publicly, the Fed's inflation target has effectively been raised to 3% from 2%. That's why we are in the midst of a rate cutting cycle, even though inflation's been around 3% for more than 2 years. We are going to get a new Fed chair installed shortly. The current chair is going to be in charge through May of 2026. But his successor is going to be the one impacting markets because markets always look forward. The new Fed chair, whoever it is going to be very much in favor of lower interest rates. We can expect the rate cuts to continue so long as inflation remains near the new de facto 3% target. And the reason is just the size of the US government debt, the unwillingness of policymakers to reduce spending, and a Fed funds rate above 1% is no longer really sustainable long term with these debt levels. So while the short term is always going to be volatile, we can expect rates to trend down towards this 1% level unless we get another inflation spike up above 4. And keep in mind, essentially every other country in the world is in the same state. They have the same difficulties. Their debt loads are so high that high interest rates are just not sustainable over long periods of time anymore.
Yeah, and to that point, there's a bunch of Fed global central banks announcing in the next week, and they're either at very low levels or they're reducing. Now, this is also another tailwind is policy. So it's very supportive. And what I mean by that, the infrastructure build out that we're seeing in the US, it's also in Germany, Japan. So it's a global expansion that's continuing. So you have two big positive catalysts, low central banks easing and also government support. That aided by, again, technology improving, these are improving efficiencies. So it's a lot of positive tailwinds that we see continuing. Another one that we think we go back and forth with is this a bigger momentum to the markets than AI? And it's the effects of weight loss drugs. And it really has two effects, and we'll get into this in a bit. One is the actual improving of efficiencies by not being overweight or being obese. But it's also the on the spend going into healthcare. So what we're seeing is companies that are now approving these treatments, their healthcare costs are going lower. That is, something positive. And perhaps maybe next year when we get our medical or our health insurance quote for the year, it's actually lower and not up 15 to 20%. Just something to think about. Alex, you want to talk about the
Yeah,
treatment?
and I think it's astonishing how quickly the technology is advancing with the weight loss drugs. The first generation, which is Ozempic, which is already one of the greatest medical inventions ever, it's already almost obsolete. And they now have a new class of drugs, which is even better than GLP-1s. They're called triple agonists, and they allow for that same amount of fat loss while sparing the muscle tissue, which is just incredible. And these drugs are even showing the ability to target fat around the liver. Fatty liver disease is an incredibly prevalent, horrible illness within the United States. And when these next generation drugs hit, the effect is going to be even more pronounced. We're going to see higher productivity. We're going to see a lower deficit. We're going to see increasing quality of life for really tens of millions, if not hundreds of millions of Americans. So, clearly one of the greatest inventions that I've seen in recent years.
Yeah, and just from a economic point of view, this boosts GDP and it, decreased costs. So that's how we kind of look at it when we do some of our modeling. Um, Now, two other points that we just want to let people know of when some of the things that we're fearful of with the leverage and when you look at lending, and we've had a couple of, big write-offs that we've seen this year, but it's not showing contagion. So it didn't spread. And two of those that we're talking about, there was a couple of bankruptcies and used car sales, but they weren't systemic. We also had Bitcoin correct over 35%. Some of those companies down 50 to 60%, no systemic risk. So the financial markets operated normal. And that's what I like to see. And that gets me more positive that these things aren't growing. But it's also something that we keep an eye on if we start seeing, follow through with the leverage and then the systemic risk. Now, as we get into, our last stages of, why we're looking for improvement, it's a calmer global stage. And really think about that. When I say calmer, it's maybe less anxiety relating to tariffs, to geopolitical, political, all these things that people might get nervous about. What if we start seeing that de-escalate? And by de-escalate, I mean we get some of these things known. And one of the big talking points is with tariffs. And the Supreme Court, this month or even next month, can opine on if they're legal or not. And Alex, you had
Yeah,
some.
it's very important to know that regardless of the Supreme Court ruling on the legality of the current tariff regime, the president has a wide variety of other legal tools that would allow for the reapplication of, most, if not all, of the tariffs. So regardless of the ruling, we're likely to see the tariff regime remain in place. Though I think it's very important to remember the hysteria around tariffs in April. This is what drove the bear market. There were a wide variety of pundits saying ridiculous things like we're going to go into another Great Depression because of these tariffs. And now, of course, that's all been forgotten because it didn't materialize. And most of the negative effects of tariffs have not materialized. Instead, we've gotten essentially promises from foreign governments to invest trillions of dollars. So just important to remember that oftentimes when you see media hysteria associated with bear markets, like April, it's usually misplaced and it's usually quickly forgotten.
Yeah, and that's, it's a good point. Politically driven volatility, which we saw also with the government shutdown, those tend to be short term and they don't reflect, deeper economic trends. And that's the take home from that. And as we look out next year, I do look at different, magazines and the covers of it. And one of my favorite to be a contrarian is The Economist. They typically, when they say something that they're forecasting, it's the opposite. And they're suggesting a global chaos for next year, and very ominous with potentially not just wars continuing, but disease and all these different things. And you can go back in time, and typically, they're capturing the right now, not looking ahead. So that gives me not just a contrarian standpoint, but that's a reflection of investor sentiment is right now. And that leads us to believe as we get some positive surprises, this market and sentiment can continue to go higher. And as this time comes around, you get a number of analysts from Wells Fargo, Morgan Stanley, HSBC, Societe Generale. All of them are coming up with their prognosis for next year, and it should be no surprise. They're all expecting the markets to do very well and the S&P to finish around 7,800. So they're very optimistic with where they're thinking. That's not something that we look at, but it's just to give you some peace of mind what other analysts out there are looking at. And Tom had some good points that he wanted to talk about with the different sectors and kind of cue us up to people that are in our strategies and what we own. We can
So,
talk about that.
yeah. So, Joe, thanks for the segue. We've had five kind of strategic catalysts to the Joe's and mine and Alex's discussion for tailwinds leading into 2026. Joe mentioned that we continue to see the leadership from the mega cap sector, and they have massive cash reserves. There's tech dominance making these mega caps the default growth engines for us. Joe mentioned the industrialization, revitalization that we have, reshoring, industrial policies changing, and the AI scale are firmly in their wheelhouse right now. We're seeing efficiencies and productivity in the U.S., and then it's spilling over globally to companies, and we will benefit from that. So the leadership in the mega cap sector, the continuation of capex expenditures is really important to focus on. When you look at the companies that are in the news, the Metas, the Microsofts, the Googles, even OpenAI, and then who's benefiting on the chip sector, the NVIDIAs, the Avgos, which is Broadcom, you can't not continue to think that this spending will continue well through 2026, 2027, and this is a very positive indicator for capex spending. So, Joe, I'm not going to go through all five right now, but the leadership in mega caps and the continuation of capex spending. Joe and Alex, please talk about that.
Yeah, and again, one of the trades we had done earlier was we sold out of Intel a while ago and bought Broadcom. And yes, they're going to report earnings tomorrow, but that has been a big winner, and that has outperformed any of the Mag 7 year to date. And again, that's kind of a competitor, not competitor, but the same kind of NVIDIA when you look at those two, but they're more open architecture. So that continues to be the build out that we're seeing with data centers, and that's helped in our growth portfolio, like a Sienna. That's one of the top performing stocks, year to date. But it's been our energy play. That's the Constellation Energy, that's nuclear power. Those areas continue to really do well. And the last one I'm going to give was Eli Lilly. We healthcare has not been a place to be this year, but that stock has been for those reasons we mentioned. And like Tom likes to mention, some of the best areas are more importantly what we did not own. And we've mentioned the retail or the consumer. And this is consumer when we look at the both what the consumer is spending and really being underweight that sector because they don't have pricing power. And as things cost more, people are buying less. When we look at kind of your basket of goods that you're buying, what we've seen is the actual amount has gone up, but the number of items you're purchasing has gone lower. So that's not good for companies. So those
Alex?
are
America simply must reindustrialize. We all know that we've gone through decades of offshoring, of factories closing, of infrastructure eroding. Any of us who drive on the roads can see it. And there is an absolute necessity for trillions of dollars of investment. And it's now been promised. Every time I tally it up, the number gets bigger. But when you add in the foreign countries, the multinationals, the hyperscalers, you're getting upwards of $10 trillion of investment to revitalize the entire physical infrastructure and industrial capacity of the US. And there's so many areas people haven't even started talking about, like shipbuilding, for example. America does not build any ships outside of naval vessels, but that's something that's going to be fixed in partnership with Korea and Japan. And there's just so much to be done.
In 2026 and beyond, circling back to healthcare, um, we are seeing advancements in treatments and therapeutics outside of the weight loss sector. You can also go into drug development in cancer, one of the areas that I focus on for private investments that we've participated with. But Joe and I have talked about how intuitive surgical robotic surgeries creating a better path to a safer surgery, less errors. We've talked about the instant collaboration that universities, hospitals, and research centers are collaborating together, and the innovations that are in place. My thoughts are that the next boom that we see outside of technology will be in healthcare and how it improves the quality of life for you and also the keep you out of the hospital for say. Do you want to touch on that, Joe and Alex?
Yeah. Yeah. And again, that's not a sector that's done well at all for
Correct.
performance. But again, it's ripe for innovation. And that's where we think the application part of AI and technology is going to really evolve. And this is companies that are putting money into it. And again, it does produce efficiencies of scale, but it also can speed things up. And I think that's just getting started. We again remain very optimistic that just once you start using it, it's the momentum that continues forward. And I just think healthcare is, ripe for
Yeah.
innovation. Let's say that.
Lots of room for improvement between the insurance carriers, the patient, the physicians, the pharmaceutical companies, biotech. There's huge room for improvement in that area.
And
Uh,
so much of the costs are administrative and these exploding insurance costs, when you really look at the number of employees, you see that the employee growth, it's administrative, it's bureaucracy. And AI is even ideally suited to try to streamline that and get costs lower for everyone, which is another necessity given that $1 trillion a year is spent by the government on this.
Right. And that goes back to the discussion about how this would impact GDP, even in certain countries, let alone the United States. if the weight loss drugs, the GLP drugs, continue to show improvement in a person's lifestyle, not only from a diabetes standpoint, obesity, inflammation, and then carries over into other sectors, it can have a material effect on the way things shape up fiscally for that. So, in the same context, if you go into the robotic surgeries, and you go into cancer therapeutics and then other pharma and biotechnological innovation areas, it really could continue this momentum in fiscally improving things. Is that correct, Alex?
Yeah, absolutely. There could be a real gain from that. And that is the ideal path towards getting the deficit under control. It is that increase in productivity. And we've seen it happen once before in the late 90s when the internet first came about. Productivity increased so much that America actually ran a budget surplus. So I think if we can get a repeat of that, we can finally get this deficit under control.
Yeah, I think that we're on to something beyond the what the general public is portraying as to be a very negative outlook for what the improvements in supercomputing and AI for that matter. This could be a positive surprise that a lot of people aren't expecting. Even from the job market standpoint, there are more efficient ways to help somebody who's entering the job market using these advancements that we've seen. Um, uh, Joe, I wanted to give you a few minutes to talk a little bit about the kind of the bigger picture that we have, this infrastructure-led innovation. And thanks to AI and power and chips converging, we're seeing a shift in this cyclical consumerism that we talk about to structural growth. And so AI fueled gains, customization of chips, new health tech, maybe even an update of our grid, the modernization there. Um, you have some closing thoughts on this, Joe,
Yeah,
on the
how
bigger picture?
I try to keep it simple in my head, and I just again, you've heard me say this before, go out and look at the Waymos driving around and the little cocoa machines, that's technology. And the number one job globally was a driver. That is going to be replaced, and it's a matter of time. And you have to stop. This is kind of goes into our thesis going forward. It's not that it's going to kill jobs, but it's going to replace. And there's other tasks and other jobs that will come from that. And that's what I think we have to start getting ahead of, is this is a tool for us. And some of these tasks that are mundane, it's being called an adult tax. We're making our lives easier. That is going to be money devoted to either robots or, technology. We're not afraid of it. I still recommend people go out and try a Waymo. And th this is the wave. And again, it's tools that'll make our lives easier and better.
I don't think I'm there yet trying a Waymo. That's just me personally. But in Los Angeles, Alex, would you get into a Waymo?
Yeah, abs I would trust it more than a person. And that's going to be incredible. There's like 50,000 people who die of car crashes, and that's probably
That's
going to
right.
go to zero. And like
That's
that's going to
true.
be that's yeah, that's another invention we haven't talked about. We're just in this period of technological advance being so rapid that it's hard to even go through all of them, but
Yeah.
autonomous vehicles is another huge one.
Oh, it's big. It's big. And then if you carry that back into the advancements with robotics and what could be the outlook for somebody in the health industry or healthcare or in the needs services area, we will be guiding that technology into helping us rather than pushing it away. I really would like to see more of that happen in 2026, and we will see some incredible things. Joe, we're going to wrap it up. We've got 3 minutes to wrap it up. Would you like to make a last comment, and Alex, and then I'll conclude it?
Yeah, just number one, thank you. Like Tom said, we mean this. We're family, and it's been a pleasure since Tom hired me a few years ago to work here. And we all look forward to coming. We just had a dinner with everyone in town, and it's always great to see people in person. And as we get into the holiday season, let's give thanks for what we have and see people in person again. And there's a lot of good things to be thankful for. And again, on the investment side, I think there's a lot of powerful tailwinds for the market. It sets the stage for a lot of favorable developments. And again, we went over all the different uncertainties that we think we get some clarity on. But the big tailwinds are here. And I hope that we have less anxiety this year. But let's, remember to go outside, breathe, and we're all fairly active in this group here to continue to be thankful for what we got.
Alex?
Just focus on the long term, try to look past those news headlines, that hysteria of next Great Depression is coming because of a 10% tariff. Just focus on the longer term because that gets you pure exposure to technological growth, which is what you want to be exposed to rather than short-term fluctuations.
Yeah, and then it's important to know that as an active manager, we do serve you as a fiduciary. We have partnerships with advisors, with private clients, our centers of influence, and you should utilize us as a specialist to to build and to have more success going forward. Um, the path forward, it won't be without a lot of noise. There's always going to be volatility. We do think that that will be reduced in 2026. We're aware of the debt concerns that are there, but there are measures in place to reduce the deficit as well as to improve the balance sheets of companies, and earnings are growing. And there are margin risks that remain, but these macro winds that are shifting right now, and the sectors we've focused on, semiconductors, infrastructure, industrials, and AI, they're at the center right now of America's new growth engine. And we're very, very excited. I mean, at Strategy Asset Managers, we believe this is a great moment going forward. And our 2026 outlook is really grounded on the fundamentals that are underpinned by this innovation that we're seeing. And it's also supported by policy tailwinds. So now's the time to really position the portfolio for long-term success. We are so grateful to be a part of your investment management world, and thank you very much for continuing to believe in us. I hope you have a happy holiday season, and you will hear from us back in 2026 in January. A little public service announcement for everybody who's still on the call. This Monday in the on Fox Business, Charles Payne invited me back to talk about our outlook for 2026. We'll see if we get into a little bit of details on there, but that's in the Pacific time, 11 o'clock Pacific or 2 p.m. Eastern time. It's a little public service announcement, but sometimes we don't get it out there enough for people. Thank you very much again for being here today, and have a happy holiday season. We're going to sign off now.